my mind. Looks like we're in the click.
What is going on, you guys, and welcome back to another episode of our portfolio update series. I'm joined today with my father, Mark, and I think we're going to dive straight into things because we got a big review here. We added, since our last review, Dad, actually a total of 7 additions, 7 buys in the portfolio. We actually made a sell, and we're going to have a bit of a new format today. We're going to start off with just sharing with you guys the total portfolio value. And as of today, we're looking at $50,000, $50,611. And for those that have been following, again, just as a reminder, we started this portfolio at a $40,000 level. So with the growth, with the contributions we've been adding, we're up about $10,000 over the past, give or take, 5 months. Been about 5 months or so.
5 months, exactly, yeah.
Pretty much 5 months or so. So moving in the right direction. But we did have a comment in from Ryan G, who says, I got to say, this is amazing content. Thank you, Ryan. Those charts add context I haven't seen before. Thanks, Brandon and Mark. One small suggestion. The portfolio review segment generally gives away your purchases as I see the new additions before you even talk about them. Have you thought about doing the purchases segment first and then the portfolio review secondarily? Just a thought. He says, love this battle anyways. And you know what, Dad? I think we're going to run with that. We're going to try and change it up a little bit and save the actual overview for the end of the video. As always, we do have timestamps down below. But
yeah, I think that's a good idea. I like Ryan's suggestion, and I think what he's saying is, let's go through sort of the activity, what you've done, and then sort of wrap it up and summarize it at the end. And I like that. It's a good way of sort of finishing off the video, I think.
I think he's right. Maybe it frames it better. It frames it better for when you do look at the whole portfolio. You'll see, oh, well, these are the reasons why we did what we did. But yeah, we'll do that. But let's actually start off with our Q&A. And by the way, if you guys enjoyed these videos, if you love these updates, we're going to keep them coming for you. Just take a moment and drop a thumbs up. That helps the channel so much. Leave your comments down below. We do always have our investing academy. So if you are looking for courses and training in Canada, that's that first link down below. But we are going to be starting off with the Q&A segment, which if you ever have any questions, you always leave them down below. We have a question here from newbie or new_B. Historically speaking, how are the cash balance for the financial institutions and investment firms been doing at the moment, as opposed to the 2008 financial crisis? I was under the impression that people and banks that are invested in the markets have a lot of cash on hands, which would suggest that a big correction is unlikely. Just a couple of years ago, we didn't have all these YouTube videos with full of insights, tips, tricks, and how to invest in the markets. With all the new apps, investing has never been so easy. With that in mind, markets could keep going up, and they could keep going up for a long, long time. And it's a great thought there by newbie with 4 thumbs up from the viewers. I guess that's a 2-part question, talking about the cash on the financial institution's hands and the difference there between the financial crisis and whether that is a catalyst for this market to continue pushing up. And that a big correction is unlikely.
Yeah, I'll speak to that, Brandon, because I haven't looked to see, which of the major institutions, where they're at with cash balances, but I do know through experience that you're going to see a wide variety. I think overall there is a higher cash balance now than you'll see, during most of the times. An interesting take that newbie has on this, suggesting that because there's such a high cash balance, it means that's less likely we're going to see a big crash. And I'm not sure whether the concept there is because things are more balanced. There's ballast on the cash side. I'm not sure. I would actually think that the fact that there is when there is a higher cash balance, that's almost indicative of some concern. And if we're looking at the big financial institutions carrying those balances, they have the insight. I would take that as a more cautious signal, actually, than I would a more aggressive signal. He does conclude by saying there that the markets can go up a long time while we're waiting for that crash. And that's absolutely true. There's no question about it. That's why we always advocate having some of your money, at least, have that portion of your money invested, as we do in these portfolios. We don't know which way the markets are going to go. I think regular viewers will know our stance. We think the markets are pretty frothy right now. So there's a possibility of a pullback. That's okay. We're not worried about that. We're still going to have, we're going to take a hit when that happens, but we're going to have, we have solid investments for the most part that are going to ride that out. We do have cash sitting on the side and some fixed income that we can always slide into the markets if we need as well. So I think we may disagree a little bit on the meaning of all that cash. If in fact there is a high cash balance, I would take that as a sign of caution. Newbie takes it as a more comforting sign. So we'll I guess
Depends on how you
ultimately see
look at it. And I think the fact of the matter is the cash balances will be higher coming out of the financial crisis with basically some stricter, some tighter policies in terms of how much cash these banks and financial institutions have to own. So making that apples to apples comparison, you are going to see more. It's more or less just about how you decide to look at it. And I do kind of lean with you there, Dad, but I do totally respect where this newbie's comment is coming from.
And I mean, absolutely. Like I say, he ended with the markets can keep climbing, and the markets climb a wall of worry, right? So there's no doubt that the fact, we don't know what's going to happen tomorrow, or next week, or next month. So it's always understanding what your risk tolerance is and playing it accordingly. Now, he or she did mention the fact that, well, I think the words were investing has never been easier or something to that effect, because there's so much, I'm interpreting it as so much access to information. And on that, I would be careful, because access to information doesn't necessarily mean that it's correct information. You always have to weigh off, in every field, every endeavor right now, you have to look and see, what's the validity of the information? So having access to it, and yes, is it easier to make investments? Is it easier to buy and sell stocks? Without question, way, way, way easier than it ever has been. I think maybe apples and oranges. That doesn't mean investing is easy. The act of buying a stock is easier today, without question. But you still have to go back to the same rules that apply as an investor, as a prudent investor. So good comments. I really appreciate that feedback. There's a little bit of ambiguity to it, to each of the comments, but I hope that my take on this has sort of helped our viewers maybe weigh the pros and cons of those suggestions.
Mm-hmm. Jonathan asks, sorry for the criticism, but you guys do great videos. I just wanted to say I don't like how you guys use the RSI, because it really doesn't show anything important for long-term value investing, because the momentum of a stock won't tell you anything about what you should be spending your time on stuff, when you should be spending your time on like reading stuff like the annual reports, making sure the long-term prospects of a business are intact and the cash flow is growing and staying stagnant. Also, I don't agree with you guys when you say that higher risk means higher reward, which is true sometimes, but not all the times. Because when you are a value investor, Graham style, the more undervalued the stock is, the higher the return and the lower the risks. So essentially the opposite. Even for long-term value investing, high risk doesn't mean high reward. I think you guys forgot the definition of risk. It is the amount of permanent loss of capital. Risk is not volatility. So if the company is a wonderful company, let's say Coke, when Warren Buffett bought it, there was no real risk, maybe like 1% or less, but the company was in such a good position in the competitive market, and their moat was huge. Thank you for considering my arguments. From Jonathan.
I love this. It's more of a comment, I think, than a question, or more comments. But this comment encompasses so many different things. And first of all, never apologize for disagreeing with our strategies. I mean, that's you are a very polite contributor, and so we're always open to ideas and sharing. And as part of the forum that we have here is to throw out ideas, and we do welcome opposite opinions. That's in fact what makes the market. You weren't rude, so don't feel bad about that. For starters, let's talk about a couple of great comment. Let's talk about a couple of things. The RSI first. Yes, I want to make it very clear, and I'm not sure which video, probably the last update that we did, we referenced RSI. I think in answer to a question about what time frames we use for RSI, and there's shorter time periods, longer time periods. I do believe that RSI is used more effectively for shorter term. I think that agrees with Jonathan's comment here. What we don't suggest is that is the only metric that you look at. In fact, we totally agree. Look at the annual reports. We are fundamentally, we're fundamental investors first. You look at the stability of the company, what the prospects are for the company. Go through all of those things first before you decide. Now, what we usually do, not always, but usually, if we're trying to decide whether we should be selling or buying a company, we kind of marry up those fundamental research aspects with some of the technical indicators, RSI being one of them. So that is only a piece of that decision-making process. So I agree in one respect that you don't base a long-term investment strategy over short-term strength. But could it play a factor in the decision as to whether you want to pull the trigger and buy or I could say, or sell a company now. I think that for us, I think it's a legitimate component to go into that decision.
I think we mentioned that too, just to clarify, like we use the RSI at the very end of our research process, where it's basically, as you mentioned there, it's that tipping point as to whether we would trigger a buy or sell or just a piece of that puzzle. Because again, he's correct when he says that, a metric like this, that a momentum metric doesn't tell you anything about value investing. But if you've already established that a stock is a good value buy, if you're taking a value approach, you say, hey, this stock is undervalued, it's got a good moat, it's one that I want to own for the next 10 years, then you can come in and use that RSI at the very end and say, oh, look, well, maybe we are seeing a little bit of a bottom here. It seems like there's a bit of momentum picking up off this low. So again, it's the final ticking point. You may look at it as in terms of your buying process. But again, as you said, we never said by any means that's what you base your buys off of.
And just FYI, I do have one of my screens. It looks at RSI, and so you could say, and sometimes, I might look at a low RSI or a high RSI, and that could bring something to my attention. Then go through, and so it could be in either order, but the predominantly you're going to look at that. Oh, let me look at this company. You're going to go straight to the fundamentals, see if it's worth buying, and then use that as one of the deciding factors. So, good point on that as well, Brandon. I'm going to talk about risk as well, because Jonathan, with all of the greatest respect, we disagree on the definition of risk, because specifically when you're an investor, there are two different risks. And through my entire career, I wrote a million exams during the time I was working, and even, for example, in an investment policy statement, a good solid investment policy statement should define what those are. So there's two. First of all, there's the ability to take on risk, and I think this is what. Sorry, really quickly there as well. I hope we didn't say, if we said risk equals return, we misspoke on that, because risk equals the opportunity for return. So high risk, high reward, that's a theoretical piece of information, but by no means is there a direct correlation, or there's no mean taking on high risk means you're going to get a high reward. To your point, risk means your ability to take on risk. So if you are a younger investor, if you have a high level of earnings, if your risk tolerance is high, it's a preference as to your investment strategy. That's one definition of risk. Another is the ability, another subset to that is the ability to take on risk. Even if you have a very high risk tolerance, if you have $1 million that you're planning on using it to buy a house in 3 weeks, well, then even though you might want to take on the high risk, you don't really have the capacity or the ability in that circumstance to do that. So there's two sides to that. There's also, I guess the third thing is there's a risk is volatility. The definition of risk, one of the definitions specifically, is the variance from the mean or from the norm. So high volatility could be a statistic measure, risk could be a statistic measure. It could also be something internal. So, if you're a younger investor, no, go ahead, Brian. Yeah.
Sorry to cut you off. No,
that's fine.
You can finish your thought there, but I think it really depends on who you're talking to. Risk can mean many different things to many different people. And I think Jonathan clearly comes from a perspective of a value investor. He even mentions the Graham principles, Benjamin Graham type value investing. And that's fair. If you are truly and strictly and only following the value investing approach on invest on the stock market, you may look at risk very differently than someone who is, let's say, like you said, 60, may not have the ability to bear risk. Then for them, a volatile asset like Bitcoin could be way too risky for them. That said, if you're a value investor and you find a stock that, hey, it may be quite volatile, but it's still severely undervalued, then there's a lower risk profile there in your case. But I don't think what's fair from Jonathan is saying that his way of looking at investing, saying that his value approach, which is clearly what he sees eye to eye with, is what every single person out there should be following, because that's just not the case. And don't get me wrong, we do love the value. If we do lean away, we lean towards the value style. So we do see eye to eye with that. But I think it's more or less a blanket statement that he's saying out there, which may not apply to every single person. I think that's one way I would look at it.
Yeah, I would finish by saying, as an investor, you need to understand the different meanings of risk, and some will apply in
meanings.
scenario A, some will apply in different B. But it's really important that you have the depth of that knowledge to make sure that you understand the complete picture. That's all I would say on that. So
Sure.
I think that I think that covers. Yeah, just again, awesome comment, and you're so polite, Jonathan. Thank you so much. So feel free to disagree, and we love this dialogue because it does allow good conversation, good discussion, and a little bit more. It's a little bit deeper discussion than just buy this stock or buy that stock. So keep it coming.
For sure.
Yeah.
Let's finish off with a question from Mark Small. What would you suggest we do with money that is needed in a short to medium time frame? Like, for example, an RESP where the kids are starting university. Leaving it all invested in the market seems too risky in the current conditions, but bonds and bond funds give returns that are worse than inflation. Same thing with high interest savings accounts. And GICs. This is a discussion that I actually just had over the weekend, or basically chatting with a friend who's he has his cash sitting aside and he's deciding high interest account. Like it's a tricky one, but this is a conversation we have over and over and over and over and over again. But what would you say here to Mark?
Well, and this almost is a follow-up to what we just talked about in risk, and short to medium term, that's the key here. And so we talked about it, and Mark even says uses the term risky in this case. So in this case, the risk is of the markets correcting. Let's say you have this money invested, you need it for your child to start college or university soon. If the market takes a hit, and if you really need that money to do this, then you can't afford to take the risk. It's one of those sad things, but sometimes you just have to pull the risk off the table. I would say, depending on the school program, if you have let's just say a relatively balanced portfolio with an equity component, your child's starting school next year. If they're on a 4-year program, you're looking at a 4 or 5 year window or time horizon. So if you decide to leave some money invested, and I don't think that's a horrible strategy, a component of it, I'll pick a number randomly, half of it or 25% or, whatever.
30%, yeah.
30%. If you leave that in the equity markets, there's a high likelihood that 3-4 years from today, that money, even if it does take a hit now, will have recovered. Meanwhile, you've peeled off enough to pay for the first couple of years of education. A pretty broad statement. It certainly doesn't appeal to everyone, and it goes back to your willingness to take risk. My philosophy has always been, in a time frame like it's 3 to 4 years, or even if it's a 2-year program, especially, I've always just opted for taking that risk off the table, or most of it off the table. And it's just, you always look at what's the upside of growing the money more. You have better school, different school, more books, I'm not sure. But the downside is usually tangible. Now, if you got $100,000 in an RESP, you're expecting the costs to be $40,000 for the plan. Well, you have some buffer there. But if you've got $30,000 invested and you're expecting to spend $30,000, it really does take the options out of your hands. So, great question. Yeah, there's you're not going to get much money right now on a bond or on a GIC or on a high interest savings account. Those the name should be changed on those types of accounts in the conditions we're in now. But I would say caution is probably the better part of valor in a case like this.
And just to tack on kind of what Jonathan's questions before, again, as you're going through that example, Dad, there's just a whole nother form of risk that we just talked about there, which is like, I think a lot of people would categorize it as downfall risk, or not being able to hit your goals. That is a completely different type of risk, which again, Jonathan's looking at it with one type of risk, which is, from the value investing approach. But in this case, Mark's faces a real risk of not being able to pay for this university if something happens in the market. So again, it's just a completely different, completely different discussion. But it is to summarize, it's a very, very tricky one. And the high interest savings accounts, it is a bit laughable at the moment. And to me, I even question, like, is it even worth popping it in there for whatever you get on a basis, yearly basis? I don't know. You can make that decision, but better safe than sorry, I think, is the takeaway. Unless you can invest it in a very low risk manner, which I think is also very, very fair. And not to just go on and on, but even I was looking at some bond funds. Some of the bond funds that we invest in, for example, even in our portfolio challenge, which we can cover later, you are still pulling in yields at 2, 3, 4%. Especially as you get up to, let's say, a more aggressive bond fund, maybe an unconstrained fund or a high yield fund or a mix of both. you are still outpacing inflation at the end of the day. Obviously better than your government bonds, but then again, there's that risk that they will be more volatile. But again, there is still opportunity to outpace inflation.
Sure.
I think that should be kind of stated.
Yeah, that's a good point. There is you can outpace inflation, or at least the core inflation that's reported today, and it depends
Or
on
at
a lot
least
of other
keep up,
factors. Like
keep up with it. Yeah,
you should be able to do fairly well over the medium term on that. Yeah,
I think so. Well, hey, let's switch on over to the activity within our accounts,
sure.
because as we
Been a
mentioned, we
busy
made
month.
busy month, 7 buys, 1 sell. Up on the screen, what you're looking at are a few of our buys here in the Questrade account. And basically, they included of the company Facebook, a new addition to the portfolio, FedEx. We also added TD Bank, which is a stock that we already held in our Wealthsimple account, so a bit of duplication there. And then to hover over to some of the buys that we made in the Wealthsimple account, we added KO, aka Coca-Cola. We added the ticker BTI, which is British American Tobacco. We added the company Unilever, ticker UL, and the company Merck. So 4 dividend stocks, all situated in the US. And I think what we are going to do is really hone in on a couple of the purchases today, namely FedEx, mainly Facebook, and just share our thoughts with that. But first and foremost, we did make a sell in the portfolio. And sells don't come as often as buys. In fact, that goes as far as saying that they're much more infrequent. But in this case, the company that we did sell was Kirkland Lake Gold. And I did a video that I can actually link up for you guys, which basically went over the gist of it. And quite simply, this stock actually got bought out, or there's a deal that was announced that this company would be getting acquired by another gold miner. And the simple fact of the matter was that when we invested in Kirkland Lake, we invested in Kirkland Lake, and we didn't invest in Agnico or another company. It's a completely different, you have to basically take it back to square one and say, well, is this where I want to put my money? And it's possible that that stock is one that we did want to hold. But at the end of the day, we were at about a break-even trade. And I think we just felt as a unit that the reasons why we invested in this company to begin with are no longer present. We're not going to be losing a whole bunch of money on this trade. It was essentially flat. In fact, I think it was up about 1%. So we could basically take that sale, pay no commissions, all Canadian dollars, and just have about $1,000 or so extra to deploy into some other ideas that we see that would be maybe more suitable. But that's basically the reason behind the sell. Quite simple.
Yeah, and I think you did a video more in depth if someone wants to take some more time to look at that. Let's look at the buys, and like you say, we're not going to cover every buy, but we're going to focus on Facebook and FedEx today to explain a little bit of the logic behind it. The logic kind of applies across the board. But the first thing is, and I know a little bit later in the video, Brandon, you're going to show some slides of how choppy the markets have been recently. And so there's no question in the last while, the markets have been quite volatile. And, that's it provides opportunities. It's, if you're comfortable with a little bit of choppiness, and if you are looking to be an equity investor, we identified a couple of opportunities in the last couple of weeks that we thought we would want to take those positions in, and both of these are in the Questrade portfolio. So just a refresher, the Questrade portfolio is more of our growth-oriented portfolio. We're willing to take some more risk in there than we would in the balanced portfolio or the wealth trade portfolio. So let's start with Facebook, and we bought shares at about $332 a share. One of the, speaking of choppy markets, if we look at the recent chart on Facebook, we'll see a significant pullback, and they peaked out early in September. But since then, up until the time that we bought, the stock had dropped almost 15%. And in and of itself, that's not a reason to buy a company. There could be very valid reasons, but I mean, it's pretty clear this came about mostly because of all the negative press that was coming out about Facebook. When we look at it purely from a technical perspective, or from a growth perspective, or from a valuation perspective, we were willing to add this to our portfolio, given the track record of Facebook, given the potential upside yet, and the fact that they've weathered many a storm in the past, and they're going through a storm now, and they will weather many storm going forward as well. When we look at the valuation metrics, we can put up a chart here that shows the PE ratio of 24 right now. This is after the pullback. That compares to around 28 on their 5-year average. And I want to speak a little bit. The bottom part of this chart shows the PEG ratio, and that's a ratio that I don't know if a lot of people use that. The PE is certainly the most common. If you are interested in learning more about the PEG ratio, the price earnings to growth, I did a video recently that explains that in more detail. And when you take the price earnings ratio, which has come down below their longer term average, and now let's look at some growth aspects. So if you take that PE ratio and if you overlay that and look at some of the growth aspects, this chart I'm putting up right now shows on most of the generally accepted growth metrics, Facebook right now looks like it's a strong growing company.
Attractive, yeah.
It's very attractive in that perspective. And so you look at the strong growth with that valuation right now. Again, if you can look past that, the bad news, the negative headlines, it looks like it's presenting a reasonable opportunity. On that note, one of the things that we typically look at is what are the other analysts saying. And if we look at the Wall Street analysts, their consensus is bullish right now. If we look at Seeking Alpha, it shows 32 very bullish calls, 9 bullish, 8 neutral, 1 bearish, and 1 very bearish. If we look at the price target of 416 right now in that range, and we bought it, like I say, at about $332. So there's a lot of upside potential in the company that for the purposes of which we're buying it here, we're comfortable with it, and I don't see it going anywhere. I mean, I'm not a huge Facebook fan, quite frankly, but we're not here to express our opinions. We're here to invest. And so for those of you who this would be appropriate, that might be a good addition to a growth-oriented portfolio, given what's going on lately. Now, another company...
sorry.
Oh, go ahead, Brad.
Yeah. That's funny, because I'm not a Facebook fan either for some ethical reasons. And it's funny how, again, I've thought for many, many years that Facebook has been a good stock to own, and it's been watched on my watch list for so long. Yeah. And I've made probably over the channel a number of videos on Facebook as a stock to buy, but it's also not a stock that I would buy for my personal portfolio. And I know it'd be the same for you in your own personal investing portfolio. You don't own Facebook, but hey, we got a public portfolio up here. This may be within what people feel is a good stock for them, and it's a chance to finally get in on the stock. And I had one question for you, Dad. Did you feel bad when there was that Facebook outage? Did you miss out on a lot?
No, not at all. I was upset the other day. The power went out at the house here, and we were watching, I think it was maybe game 5 of the ALCS, or I was watching a baseball game, and we missed the last part of the game. Thankfully, we still had 3G, obviously, and we're able to stream a little bit on the phone. But no, I didn't miss. I don't do Instagram. Messenger,
WhatsApp,
WhatsApp, no, I didn't skip a beat. Glad to say.
Good. Hey,
well, if YouTube went down, I'd have a trouble.
If YouTube went down, that'd be big problems. But yeah, no, I think a lot of people. There was a lot of commotion when those did go down, and I although I'm like weeding off those platforms, you still notice it. There was multiple times a day where I actually just whipped out my phone and just automatically went to go refresh my feed. And I guess it was just almost second nature at that point. That's when you realize, oh crap, I'm looking at this way too much.
Well, and it is interesting how everybody, so many people claim to hate Facebook, and I don't like Facebook. I'm never going to use Facebook. Yeah. And yet when this happens, it's a big deal. Well, it shouldn't really be a big deal. It kind of reminds me of the old days when they cut back meals on aircraft, because people for decades complained about the food on aircraft, but the moment they stopped serving food, there was a big uproar, same kind of thing. So I don't know, you can't win, can't lose. Can't win for losing, as they say.
There you go. Well, hey, let's switch over to FedEx, which is going to be the next company that we added. And we added this stock at $225.43. And yeah, very similar data. I mean, I can let you take over on this chart if you'd like to speak on it. But again, we saw another pretty significant dip. This one double the size of Facebook's drop. About a drawdown of about 30%.
30% drawdown. And, I get, well, obviously the company's out of favor right now. And there are some headwinds, no question about it. And I think the biggest talked about headwind out there right now is what's happening with Amazon. And Amazon is building up their own delivery service. And clearly they're a big contributor to FedEx's revenues and bottom line. So I think that's legitimate. But is it enough? Is it, has the pendulum swung too far in a 30% correction on FedEx? I think the answer is yes. I don't see FedEx going away. Will they have to adjust? Absolutely. But, again, they're a proven company. When you look at, again, I'm going to look specifically at this combination of the valuation and the growth. And in this case, I mean, their valuation, let's have a look at this tables here showing valuation metrics. And, across the board or up and down the line here, doesn't matter almost any way you look at a valuation measurement on this company. They're trading at attractive values there, about 11.5 on a PE ratio compared to their longer term 5-year average of around 15 or so. And that price to earning to growth, the PEG ratio in green there at 0.78. And just as a refresher for those who aren't familiar, there's no golden rule, but generally if a company is trading below with a PEG ratio of under 1, that signifies that there could be some, there could be a good opportunity to pick that up there. Analysts rating on FedEx, again, predominantly bullish in this company here. You mentioned, Brian, I think 225 we bought that company at, and the price target is about 308 from Wall Street. So when we factored in predominantly, it caught my attention with that big drop and started looking at is this something more permanent? But I just think there's a good value in that company right now. And FedEx is a company that I would own also in the Wealthsimple more balanced account. We didn't buy it in that account. Pretty volatile right now, but it's a company that I would be comfortable holding in either of those portfolios without question. So those are kind of a bit of the logic, a bit of the story behind both Facebook and FedEx as to why we added them to the portfolio. And, we don't have time to go into every other company, but every companies that we added. A quick note though, we did add with the other companies that we added to the Wealthsimple. One of the main objectives was to add depth to the portfolio. We added basically to the consumer staples sectors, which even if there is this continued shakiness in the market, I would err a little bit on the side of caution in those, and they should provide some good resilience to the portfolio as a whole. We can talk, I think, more about. Yeah.
I don't think we need to get in too deep because again, these are just on the screen. They're looking at them, but it's just for quality dividend stocks. Some with higher yields than others, but for that, I don't think we'd have any issue with going forward. And it's just again, you're getting exposure to multiple sectors with these additions alone, and it's just a way of bringing up that yield in our portfolio. Just slowly and steadily as we go. But hey, we're about 30 minutes into this presentation, so I say we kind of wrap up and we can now finish with the portfolio update. So now you've kind of seen the inside. Let's look at it from a 30,000 foot view. And a reminder, this started 5 months ago. Each account started at $20,000 a piece. But here's the Wealthsimple one trading today at $25,605 with a total of about 15 positions. Questrade, on the other hand, again, very similar returns. This one's also sitting at 25,000. Very different paths. If we actually did a little bit of a number crunch here, and we have seen quite a bit of range in returns. The volatility that we've seen within the holdings have been quite big. I mean, if you look at this chart alone, we have our highest performing stock being Google or Alphabet, up 22% since the time we purchased. While on the downside, we have Alibaba down 26%. So you have even swings pretty much both ways. If you look at the portfolio, you got about half of them up, half of them down. And I really, really like this chart that we actually talked about in our last video when you were here. Remember that, Dad? When we basically talked about the choppy markets and we talked about, for example, the S&P 500 on a daily basis. The past few months have just been choppy. About 50% of the days up, 50% of the days down. It's the exact same on the TSX. You're seeing just as much green as you are red. And of course, the NASDAQ is a very similar story. But I think the takeaway from that is that, our performance, the fact that our stocks, half of them are up, half of them are down, this is a pretty good representation of the market. It'd be a different story if the markets have powered on and all we've seen is green, 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 green. And then we have half of our account in the red. Well, that'd be maybe not the brightest thing. But not to beat a dead horse, we've shown this chart as well so many times, but it's that range of returns that you can expect over a 1 year period, over a 5 year, over a 10-year, 20-year rolling period. We're still very much in this first time frame here, and it's quite common to see the ups and downs. It doesn't mean anything about the companies being more or less poor selections or more or less bad companies that we've selected.
Not amazing companies, not poor companies. And this, I think what's happened over the last 5 months is really coincidentally, or maybe not, very, very representative of how the whole purpose here is starting from zero and building up a portfolio. And this is what you're going to see time and time again. Interestingly, even though the returns at the end of the day have been, like you mentioned, Brandon, pretty similar from the growth portfolio to the balanced portfolio, the variances have been much more. You looked at Alphabet, that's in the growth portfolio, up 22-23%. You look at Baba in the growth portfolio being down, and if we look at sort of the full range, the vast majority of the Wealthsimple portfolio is more sort of a smaller range, but some up, some down, and the growth portfolio, a wider range, is exactly what you'd expect. Now, if the markets had over the last 5 months powered up, I would have expected the growth portfolio to be significantly higher than the balanced portfolio. Conversely, if the markets had gone on a decline, I would expect the opposite. You would expect the Wealthsimple portfolio to hold its value more than the growth. And I like the fact that we have these two different portfolios, because we will, as we go through the coming months, we will see those times again where it's not a day up or a day down, but we'll see some periods where we have longer sustained growth or declines, and that will really highlight the difference in the different types of portfolios, which is, like I said, that's one of the main reasons we're doing it this way, is to have to highlight those. So it's been a good educational sort of experience so far, showing different paths, but at the end of the day, same numbers. And the chart that you had showed just a minute or two earlier, in the short term, we're going to see this. Now, all of these companies we would expect as time goes by are going to start, getting closer and closer together. And we don't want a portfolio that's doing one thing only. To me, that's a sign of a poorly constructed portfolio. If it's way up or way down, you're always going to have, if you have a properly diversified portfolio, you're going to see a little bit of each within the different constituents within the plan itself. That's kind of my take on that.
And just to finish that off and dial that point in, if we put up basically a screenshot here of the Questrade growth portfolio, what we see is, in terms of the sector allocation, very, very heavily weighted in infotech or technology. You have your consumer communication services, you have your industrials. Three, more or less, we can call them growth sectors. When we do toggle over to our Wealthsimple balanced portfolio, well, you see that the top weighted sectors are very different. Consumer staples, financials, fixed income, obviously. Again, just kind of displaying that difference for you guys. But I think, with that, I think we should wrap it up here.
Sure.
Unless you have any final thoughts. But if you guys enjoyed so far and you appreciate these updates, again, I will remind you, please take a moment and drop a thumbs up.
Great.
Subscribe to the channel if you aren't already subscribed. But one final thing that I forgot to mention: our cash weighting still ranges in the total portfolio between 10 and 13%. 10 for I believe it is our Questrade portfolio, 13% for the Wealthsimple portfolio. But let's just call it about
10
other way
for
around.
Wealthsimple, 13 or so.
13 for Questrade.
12.5
Ballpark,
overall.
let's just call it an average there of 11.5, 12% cash at the end of the day.
Yeah. So when that, where what we saw over the last month, we did see us put some of that cash, and we'd been sitting at around 20%, on average prior to this. And so we were able to take some of that cash, and, we're hoping that we got some good value on the companies that we did add to the portfolio. And if we see, with the markets will give us what they're going to give us. And I would be welcome. I'd welcome some gyrations in the near term to put the rest of that money, or another chunk of that
which we've already seen. Yeah, which we've already seen. And again, we should wrap up here. We should. We really, really should. But I mean, for people that have been following along religiously for each of our updates, like maybe 2 months ago, 3 months ago, we specifically made a video saying we're not making that many purchases at the moment. We said, hey, sorry guys, we're just not making that many. Do you still want updates? It's how it is. Yeah. Then you come to this month and we made 7 additions. So hopefully that's a good teaching point as well. Like you said, we take what the market gives us, and we had that cash ready. We weren't over eager going back a few months, but now that we've seen the choppiness, now that the markets are starting to present us with opportunities, maybe nothing drastic yet, you see more and more cash deployed, which I really think is the name of the game at the end of the day.
Yeah. We're finishing up. I will mention again, we so appreciate the comments that you put down below this video here. there have been some amazing, insightful comments that have been made, and we welcome those. I know one of the favorite parts of this presentation or of this video is the Q&A, and we hope to keep that going there. So give us those questions. If you disagree with some of the strategies, throw it out there. Please be polite.
Leave it
I'm
down
a
below.
pretty old guy. Yeah. I can't take all the abuse that sometimes the internet dishes out as well as Brandon can. But
no, you'll be fine. We'll be fine.
I'm sure I will be. But if there's a way to say something we politely disagree with you, bring it on, because that's maybe teach us a thing or two, or we'll it'll be a great talking point for our next video. So we welcome that, and I appreciate, even if we didn't answer your question, thanks for leaving them, because we try and consolidate and work them in. If you like a question someone else left, give it a thumbs up, because that's another indicator of what is what people are looking for us to answer.
Right. For sure. Well, hey, let's wrap it up here, guys. Thank you all for sticking with us throughout the video. If you haven't already, again, I'll remind you, please drop a thumbs up, subscribe if you aren't, so you can see more content like this. And then last but not least, as always, we do have our Investing Academy. If you are someone in Canada who wants to become part of our community, you want to look at courses, training, our private membership group, that is all down in the description below. You can go ahead and visit our website to check out more. But yeah, with that said, I think we can wrap it up here. Good to see you, Dad.
Good to see you, Brad. It was nice last week when I was in Vancouver and we could sit side by side and do our videos. But 2021, next best thing. So good to see you.
Next, for sure. Well, hey, guys, thank you all for watching. Everybody have a great week. And yeah, you too have a great week over there, Dad.
Thanks, Brad. See you, everybody.
All right, talk to you later. Bye-bye.